Welcome to the new episode of MoneyWorks4me podcast. We are recording this session on 4th of October 2021. Our today's podcast is about a company from a sector that has been most favored by the market since the world is moving toward digitalization and which has accelerated since the beginning of pandemic. Yes, we are talking about the IT sectors which forms around 17% of Nifty 50, 10% of Indian GDP and major portion of Indian export revenue. To discuss more, I have with me our equity analyst Rishikesh Bise. Hi Rishikesh.
Hi Aditya.
So Rishikesh, can you brief us about Indian IT sector?
Yeah. So Aditya, for the world, what China is for manufacturing, India is for IT. Indian IT sector is known for its scale, efficiency and most importantly the low cost workforce. Our technical experts cost lesser than their counterparts from the developed world. Talking of these IT companies in India, these companies are generally having a typical characteristics like ROC of greater than 15 to 20%. They virtually have zero debt. They have good cash flows and their operating margins are mostly to the north of 15 to 20%. And they generally don't require capex due to their asset-light nature. Their biggest assets are their employees.
So, why do you think Indian companies stand and have an edge in global IT space?
So Aditya, a developed country like US would hire an Indian IT company because to get the same job done in US, it would cost as much as 2 to 3 times higher than it would cost in India. Now this is because of the differentials in the pay scale of employees in India versus in US, and this has also got to do with the value of rupee versus the US dollar. So this low cost workforce benefit helps Indian IT companies to take up more and more projects and utilize the employees by reducing their idle time.
Okay, that was insightful. So moving on, let's dive into one of our winners from IT space which has grown multifold. Persistent Systems, we recommended this company back in Jan 20 at the share price of 700 rupees and today it is trading at about 3700 and odd. So can you throw some light on what made you recommend this company?
Yeah, Aditya, so we have been tracking Persistent System for quite a long time now. We have been tracking since it was a small cap company with a market cap of around 4,000 crores. So the company had large part of sales coming from project-based business, which tends to be volatile in nature. And just like any other small size IT company, Persistent too had risks from client concentration and occasional disruptions on margins due to their short tenure projects. But we saw change happening in Persistent Systems in July 19 when it hired a new CEO from IBM, a new head of technology services from HCL Technologies. So the new management had a new strategy in place to take company forward. It highlighted to focus on long-term annuity-like models in services business to ensure some stability in sales. Measures to cut down less profitable clients were also taken to improve the margins. They also plan to cross-sell existing clients for the larger deals instead of the project-based deals. So all this got us interested in the stock, and we had already seen quite a lot of hiring in sales department by Persistent Systems, and this gave us confidence that we can expect to see the results soon. So we just had to wait for the sales engine to start firing.
That sounds interesting. So when you saw this company, did you find the valuation comfortable or say cheap enough to consider buying?
Yeah, so Aditya, as I said initially, Persistent Systems was usually ignored due to its volatile performance on quarter-on-quarter basis versus the other IT business models which showed sort of consistent linear quarter-on-quarter growth. So Persistent Systems was below the valuation of an average IT company as well as its own historical valuation. And when we recommended a buy on this stock, it was trading at a price to sale multiple of less than 1 times and a PE multiple of as low as 12 times. The cash per share was rupees 180 per share, which was almost 25% of the stock price back then. So what more valuation comfort would you need for an IT company?
But Rishikesh, as they say, cheap is cheap for a reason. Since the valuation was cheap, were there significant risk involved? And What was your perspective on those risks?
You're right, Aditya. Cheap valuation exists for a reason. And as I said earlier, Persistent did have volatile sales growth and fluctuating margins. But market often reacts late to the changes in the company's prospects. The plans taken up by the new management were pretty in line with what an investor would expect from a company. So the Persistent Systems had delivered stellar growth rate of close to 21% CAGR in preceding 9 years and about 15 plus percent CAGR in operating margins. It had consistently earned above 15% CAGR and free cash flows were equally robust. With such track record, we believe that the company has an ability to deliver on stated goal. And even if it did not, we had high comfort on valuation because we had bought it at less than 12x P.
Okay. So when you were considering all this, did you expect this could be one of the biggest winners like a multibagger?
Multibagger, no. We follow fundamental investing and believe in buying good quality companies at reasonable price or preferably at a discount to its fair value. So it's our faith that when you buy something below its fair price, it does pay you off. Of course, we didn't buy Persistent Systems thinking that it would go 4x from our buying, but since the story was strong, we did believe that stock would deliver our target return of 15 plus percent CAGR. So the tailwinds in the IT sector was definitely a surprise to us as it was to the market. COVID simply accelerated the demand for IT space. COVID-led lockdown pushed companies to adopt cloud and digital infrastructure in hurry. So Indian IT services were clear beneficiaries of this tailwind. We have seen other IT stocks also clock healthy return. So quite a few investors missed early gains in the IT stocks. And as per our process, even if we did not have COVID-led tailwind in IT sector, we would have earned healthy returns in Persistent Systems as we had bought it at the cusp of major change in the way it conducts its affairs.
Alright. So what made you recommend reduce on Persistent Systems in May 2021?
Like I said, Aditya, the IT companies benefited for acceleration in demand for IT services across the world. This provided visibility of growth in otherwise decimated economy during the pandemic period. This sector had a lot of quality companies and promise for the growth. The market kept valuing IT stocks higher and higher in anticipation of such high growth to continue in the very long term. And when we conducted our fundamental valuation based on various growth rate assumptions, we found that the market is pricing a lot of growth for Persistent Systems. So the stock price growth exceeded the earning growth of the company, and which we believe puts the risk on the future returns. As the stock grew, it also formed the higher percentage of our portfolio. Hence, we recommended reducing the exposure partially and brought down the allocation to more reasonable number. So this was a part of our risk management exercise that we do.
So what is your stance on the IT sector in the current situation?
So Aditya, at the current juncture, we are seeing continuation of demand and deal flows for the IT companies. We remain positive on most of the stocks in this space. However, we are a little cautious on the valuation front going forward. So higher demand for resources is causing a lot of attrition and cost of employees is going up. Besides, as the economies are opening up, travel resumption will add to cost and become pressure on the margins. A lot of mid-cap IT companies are valued at premium to their large-cap peers. We think it is tougher for mid-cap IT companies to manage costs. Valuation provides no comfort today for fresh purchase. We have exposure to 3 to 4 IT companies and we are selectively adding only 1 to 2 names. So we always recommend buying companies ahead of their good performance. We believe that buying stocks that have already delivered superior performance in recent past can lead to disappointment. So either your returns won't be as good as going forward, or your downside can be high if the sectoral cycle reverses.
Alright, thank you so much Rushikesh for your valuable inputs. To all our listeners, you can find us on Google Podcast, YouTube and Spotify. And if you want us to discuss on any specific sector or stock, do let us know in the comments tab. Thank you.